Hello everyone. Hi George. Thanks for joining in today. We are back with the second episode of Tech Behind Debt and with George as our guest today. So George is the Chief Risk Officer and also the co-founder of Yabex. He started Yabex in 2018 and since then we've scaled millions of profitable portfolios across Africa. We're working in over 15 plus countries, simplifying financial services to the underserved segments. So, yesterday when I was preparing for the podcast, I stumbled upon this report called Finance in Africa report, which surveyed 78 banks to understand their concerns post-pandemic about the industry. And more than 50% of those banks were worried about the deterioration of their loan portfolios. 20% were worried about the risks of new lending, and almost all of them were worried about how small firms and MSMEs are going to lose out of all the formal financial benefits that they might have had if not because of the pandemic. So this is the reason why I wanted to have a conversation with you, George, because you have considerable experience as well in the market of credit, and talk about how to manage loan repayments better, because that's a very big concern for bankers, especially in Africa, and also have a macroeconomic viewpoint of the continent and understand how the banking industry can have a positive impact through certain strategies across Africa. So the first question I would like to ask you, it's a direct question, might have a difficult answer to it, but the direct question is, how are some countries more stable than others? How are some countries within Africa as well have better growth rates, have better economic performance? And these countries which are on the higher end of the spectrum, what are they doing right?
Yeah. Thank you, Tuhina, for taking the time. So, just to take a step back about Africa, I think the first thing that I would start by saying is Africa is a very young and fast-growing continent, and you have almost 1 billion people, similar to India. But I would say, in terms of the expectation, the population is expected to double to nearly 2.5 billion people in another 30-40 years, right? So it's a huge market that we're looking at, and I think it's definitely an emerging market in a lot of ways. If you trace the history of Africa over the last 30 years and compare it to, say, two other emerging markets like, say, India and China, one of the things to notice is, the growth of some of the other emerging markets has been higher than Africa. So over the last 30 years, China grew at 8-9%, India grew at maybe around 6%, and Africa in aggregate, all the 54 nations put together, is around 3-4%. Now, within that again, there are different periods where the growth rates have been sort of different. If you take the last 20 years, at the turn of the century, there was a period where there was a lot of expectation of growth, and there was a growth of 5-6% across Africa. And post that, however, there has been a moderation in growth, and it's dropped to, say, 3%, around 3%. So it's been a little bit of a story of ups and downs, if you will. And I think some of the points that you're hearing about credit challenges that some of the banks are probably encountering is that post the 2020 decade, there was also the pandemic. So that caused further reductions in growth post that as well. So in a period where the economy is probably not doing that well, at least pockets are not doing that well, that causes impacts with respect to the ability to repay, the kind of credit offtake that is there, and the economics and the viability of the banks become challenging, and they start becoming a bit more risk averse, right? So kind of peeling the onion a little bit, right? So the question here is, is it really the same across all the countries in Africa? And the answer is no. Africa is actually such a large continent that you'll have to break it into different parts. And I think at a very high level, you can think of two sets of countries. There are countries which have been growing consistently over the last 20 years or growing more recently. And there are countries where they've probably they used to grow earlier, but they probably have sort of are seeing a moderation in growth or even a reduction in growth in certain cases. So those are the two major buckets that we can look at. So East and West Africa has been growing consistently, and it's been growing north of 4-5%, right? And these are countries, for example, like Tanzania, Uganda, Rwanda, Kenya, Zambia, right, in East Africa. And then in West Africa, you have Ivory Coast, Senegal, Togo, Benin, etc. Right? These are areas which are growing, I would say, relatively consistently. And if you look at other countries which are the big five, like Egypt, Nigeria, Morocco, Algeria, South Africa, they have experienced significant reductions in their growth between, say, the period where they were growing well back in the 2000s, and now probably they're experiencing challenges, right? And if you just try to think about what are the factors that cause this difference in trends, right? I would say one major factor is really uh, the reliance on commodities. So Africa is very rich in natural resources, right? So Nigeria exports oil, natural gas, you have gold, you have metals, a lot of copper, steel, iron, etc., right? And diamonds for that matter. So you got all kinds of raw materials which are exported out of Africa. The demand for that was very strong in the turn of the century, particularly powered by China. And I think post the financial crisis, there definitely has been a reduction in demand, and disproportionately a larger share of that drop in demand came from Africa. So there was both a drop in price as well as a drop in demand, and the exports which used to power growth started kind of becoming a drag on growth. And that is the story of some of these big countries that I just mentioned. On the other hand, if you look at some of the countries in East and West Africa, I'll take an example of a standout country is Ethiopia. It was a closed country. Practically, it was not open to foreign investment, and there was a lot of restrictions, and it was practically like a government-led economy. And over the last 10 years, it started opening up. So it is experiencing the growth that typically, say, for example, India experienced back when we opened up in the late 90s, right? So it's going through its investment phase. You got foreign investment coming in. They're setting up investment in different industries like light industries, textiles, etc. There's also investment in services, etc. So I'm using that as an example, and they're growing at more than 10%, right? Similarly, you have countries in East Africa and West Africa which are also growing at probably not such a high rate, but still similar, I would say, good single-digit numbers.
Yeah,
6-7% growth rates, and it's driven by a combination of the fact that they are a little early in their development cycle. They are investing in driving urbanization, investing in, I would say, in the services sector, and it's kind of relatively starting off on a smaller base that allows them to grow a little faster, right? So that's basically I would say the broad sort of view of how the differences are. Looking forward, right? I think the question is, from our standpoint, we are very bullish on Africa, and I think the question here is, what are some of the enabling things that will cause us to support that growth, right? So if you think about the GDP, you have 3-4 major categories. You got your services, you got manufacturing, and you got agriculture and allied categories, right? One of the key things that's happening across the world, across all emerging markets, is the shift from agriculture to services. And services right now, let's say in Africa, is about 30% of GDP, and that's probably going to be 40% of GDP in the next 20-30 years, right? So you will expect that shift from agriculture, the excess labor from agriculture going into services. The question here is, how do you create jobs and employment in services category so that labor can be productively employed?
Correct.
And can be leveraged, right? Now within services, there are a lot of categories, but I think broadly speaking, you can think of services which are trade related, which are related to retail, supply chain. Ultimately, the local kirana store shopkeeper who is actually providing you goods and services, right? That is still developing, and I think it's still relatively low in productivity in Africa. And there's a huge opportunity to improve the efficiency of that. The second category of services which is there is financial services, for example, telecom and so on. Those are fairly high value services, and is probably also going to grow. But that's one of the bright spots, if you will, in terms of what is the growth that's going to be happening on services, right? But in terms of where the government can probably intervene in a constructive way, there are 2 or 3 areas. One is Africa is famous for all its natural beauty. And tourism is a place where I think definitely some investments can go in. Beyond that, I think there is opportunity to invest in technology from a telecom and from a software standpoint. India has been a poster child in terms of leveraging labor and from a services standpoint, you have the whole call center, business process outsourcing happening from all over the world. India is the office of the world, and Africa can do the same thing. Probably maybe not at the same scale right now, but at least in a large part, at least serving the business processing needs within Africa as well as Europe, and maybe the US as well, right? And the other thing which can be done from a services standpoint is investing in education, because I think ultimately to have one of the things which India I think did a great job of is that people had the education to actually take those jobs up and be employed. And I think there's a need for a similar investment in education that needs to happen, education and skills that will allow the services sector to grow at a faster pace. Switching to manufacturing, I think manufacturing will always be, will not probably consume that many people in terms of employment, but the opportunity for manufacturing is more about investing in some of these industries that we just talked about, ensuring that the value added from, let's say, mining of copper. Can you extend that to the refining of copper as well, right?
Correct.
The value added with respect to just mining the diamonds, can you actually create a supply chain so that it actually, you capture the value of the final processing of the diamond, the polishing of it, can that be done, right? Any of these things which are natural resources, rather than just providing the raw product, let's say cocoa in Ivory Coast, can you sell coffee as opposed to selling cocoa beans, right? So if you can create value added services, adjacencies with respect to the supply chain, and create those capabilities by deploying capital, deploying labor in a productive way, then you are able to capture a larger share of the value, and you are able to export that finished product, both within your own country to consume it domestically, but also exports, and that will help in driving the growth from a manufacturing standpoint. I think the third leg is more about trade. I would say Africa is surprisingly, there are more trade transactions happening between Africa and other continents and other parts of the world than within Africa. And there is definitely an opportunity to think of the equivalent of the European common market. Is it possible to create a common market for goods and services in Africa, where the friction associated or the barriers associated with transporting goods and services across these countries can be reduced? For example, there is like lines that are on the border. For example, if you cross over from Tanzania to Uganda, and these are all they're there because some of these value-added tax and others, customs duties, etc. Those are not converged. It's not done in a manner that is streamlined, and there's a lot of opportunity to improve the logistics by having some of these common market policies in place. There is also a need to create supply chains which can leverage, so that means you're investing in logistics so that you can move goods and services faster, and also, for example, have warehouses, right? As well as the financing of some of these things. For example, as a farmer, if they're producing a crop, they need some assurance that it will get sold at a certain price. So having those forward markets, having the credit available to buy the inputs, all of those things will strengthen the supply chain from a trade standpoint. And I think just closing the thought with agriculture, while it is a smaller share of the GDP, but it still employs half the people, and there has to be ways to expand the scope of agriculture again, as I mentioned, in terms of providing value-added products, which can be offered both as like FMCG products that are sold, rather than importing some FMCG product like a coffee from somewhere else. Africa should be able to have its own brands,
Correct.
which is able to serve the local population, both within the same country as well as across the countries in Africa, and also export the same, right? So net, I think with the right policy interventions across some of these categories like services, manufacturing, and agriculture and trade, I definitely think that there is a huge opportunity, and hopefully the leadership in the various countries will be able to be visionary and be able to execute some of these policies and help realize the potential of Africa in terms of the demographic dividend that's coming their way.
So you say that the future of Africa looks quite bright.
Looks bright. I hope that some of these policies are implemented as well, because it definitely there are scenarios where people don't implement the policies well, and that creates challenges. So there are countries which have gone in the opposite direction as well, and that creates difficulties for the population there, and also it shrinks the GDP, and ultimately there is it becomes a shrinking opportunity from a market standpoint if the policies are not deployed correctly.
Very, very interesting.